So
We can start.
yeah, we can start now. So good evening, friends and Cost Accountant Association. I, Amit Cheda, the president of association, thank every participant across the globe. It gives me an immense pleasure to welcome for today's speaker, CA Manoj Bhai Shah. Welcome, Manoj Bhai, for accepting our invitation and share his view. Friend, many of you from may not be knowing what is a CVOC association since you may be from a different part of the world. So let me introduce our association. CVOC is a non-profit motive association of chartered accountant, cost accountant, and a company secretary. We generally belong to a small district of Kutch of Gujarat. It's a very small community as such, but very well bonded within our community itself. So our very first visionary chartered accountant of the community, CA Devchand Bhai Gala, started this association in the year 1973. Today we are at celebrating our 50th years with more than 2,000 professionals like CA, chartered accountants, company secretary, and ICWA. And we feel very proud to say that we have professionally managed association for professional and by the professionals. As I mentioned, we are this year celebrating our 50th year, and in line with our celebration, we have taken up a lot of a mission of a financial literacy. So what we are going each and every month, we are going to have a program for a financial awareness within the society. We wish to cover each and every section of society, be it HNI or maybe middle income group, or maybe staying in suburbs or maybe in a downtown. We are trying to touch upon each and every base of our community. This we have as such organized many such programs on the financial awareness, which are from the rights of common man in terms of when he is buying a new property or maybe when he is investing in equity shares or any to create this kind of awareness of his right. Maybe we are again trying to touch upon by keeping up programs on various in policies, like maybe in medical to get an awareness within the society. Similarly, in last month also, there was a budget which was announced by the Minister of Finance. Within 1 week of that budget itself, we organized one awareness program. And within the 5 days of the program, we came out with a budget booklet. Now, that budget booklet is generally in English and in Gujarati. And we are the only association who prepares a budget booklet in Gujarati. And a lot of pain in preparing entire budget in Gujarati mode. So it's one of the only kind of general public. We have a lot of committees. One of the committee, Capital Market Committee, has been organizing and a lot of programs within India. And what are the latest economic development which have been taking? In fact, we recently did a technical course on a training course on a technical analysis altogether. It was around 7 days course for various topics on technical analysis. We have a publication team which takes care a lot of skill development programs. GST and income tax compliances of late. We have been running on a software skills like Power BI. This kind of skill programs have been and guaranteed the student with a minimum job requirements. There have been a lot of various connected with the various MNCs and large organization. And in my estimate, 500 such a student, and they are very well connected right now with the team of finance of the MNCs. Apart from that, we also have a dedicated education fund, named is CA Shri Shantilal Veshi Khiraj Haria Education Assistance Fund. We have been giving soft assistance to the needy students who are doing professional course from our community. Of late, education has become very expensive in India and out of many reach of many of the families. So to ensure that those child doesn't suffer, we have tied up with a lot of classes in Bombay, and those are very reputed classes who, based on our assessment and our certificate, extend 1/3 discount to the student, and we try to fund those students with remaining fees of 2/3, and though they can repay those amount without interest and at the most convenient terms to them. Of late, world went to COVID. In that time, we also then when everyone went into online, we try to assist students with laptops, computers also. And in last, I think in last few 3-4 years, we have disbursed more than $500,000 of USD dollars to needy student, and I think more than 200 students have taken advantage of that. And this kind of arrangement we have been doing from last 10 to 12 years. Uh, those students who have gotten assistance from our association have completed their studies and have upgraded not only themselves but the entire family of theirs. So I think a very nice program being done by our association on for upgrading students and the needy family of the society. Apart from that, we have a dedicated YouTube channel in the name of CVOCA. We have more than 175 to 200 hours of very quality content. And these are on the topics of maybe a financial literacy, financial planning, capital market, or maybe an investment planning, etc. I would request all the participants to at least subscribe our channel for a regular update, and you will get a notification accordingly. With this introduction, I will just give a brief of this program. Today's program is in line of our core objective of financial awareness. Many of our Indian families are settled abroad from ages. They have many questions on various compliances such as tax liability on sale of inherited properties, tax liability on rental income, and if tax is deducted at source, how to claim those refund of those things, of those withhold tax. Further, whether they do need to file and return with Indian tax authority. So those kind of lot of questions are there within the Indian diaspora. There are certain questions on FEMA which are like how do we invest in India and we try to access the capital market for a better investment opportunity. How do we have a direct investment? What are the rules available for a direct investment? And to address all these questions, we have very knowledgeable speaker, and I am very sure he will take justice to that. And he's a master in FEMA and direct tax provision for NRI. So I am very sure he will be able to do a justice to this. With a small introduction, I would request Harish Bhai Chheda, who is chairman of the program today, to take this thing proceedings further. Over to Harish Bhai.
Yeah, thank you, Amit. President of CVOCA Association, other office bearers of the association, today's learned speaker Manoj, and all the participants. At the outset, let me thank CVOCA Association for granting me this privilege of chairing this session. As the President Amit mentioned, this is a part of Golden Jubilee celebration of CVOCA Association that the association has arranged a virtual seminar workshop on the provisions of NRIs, provision for NRIs diaspora under the FEMA and the income tax. And I'm happy that for the job topic they have chosen, and also for the speaker that they have chosen. We could not have got a better speaker than Manoj Shah on this topic. I assume that many of the participants attending would be NRIs, and across the world, at many places there are no restrictions on cross-border transactions. However, in India, even after the liberalization of 1991, there is not full convertibility. And by and large, cross-border transactions, including the transaction between residents and non-residents, are governed by what we call as the Foreign Exchange Management Act. And it is very critical for people dealing, residents dealing with non-residents and vice versa, to strictly follow the law, because in implementation, the interpretation and following of this law is very different from the other regulations such as Income Tax Act, and this is managed by RBI and rather very strictly. So certain areas which would be of interest to all the participants would be provisions applicable to returning Indians. It is very important for the returning Indians to plan their financial affairs before they become residents. Certain things that they can do while they are non-residents perhaps cannot be done while they return to India. Same way for going Indians. So in our office, we have got a practice that our clients or their children, whosoever, go at least 6 months before we enter into a detailed discussions that what steps need to be taken. recently, as everybody must have heard, all Indian residents are establishing family office overseas. Also, loans to and from non-residents are a matter where we need to look at the provisions of FEMA. Insofar as the taxation goes, one needs to look at the double tax avoidance agreement. There are certain tax advantages to NRIs. For example, in case of mutual funds, in case of certain countries, the capital gains from mutual funds would not be taxable in either of the countries, neither in India nor in the country of the residence. In certain cases, under the Income Tax Act only, there are certain beneficial provisions where there are concessional tax rates, for example, in case of unlisted shares. And many more things where we are awaiting guidance from today's learned speaker. With these few words of introduction, I will now request CA Pritin Shah to introduce the speaker for today's evening, CA Manoj Shah.
Thank you, Harish Bhai. Manoj Bhai has qualified as a chartered accountant in the year 1987 and is a founder partner of the firm Shah and Modi Chartered Accountants. His focus areas of practice are exchange control regulations, FEMA, international taxation and transfer pricing. He is past president of the Chamber of Tax Consultants and CVOCA Association. Presently, he is assistant editor of monthly journal of the Chamber's Journal. He has delivered various talks on FEMA and non-resident taxation at seminars, conferences at various forums across India. He contributes to FEMA Update column of newsletter and journal published by WRC and ICI India. He is regular contributor and co-author of publication that tax withholding from payments to non-residents published by the Chamber of Tax Consultants. With this brief introduction, I welcome Manoj Bhai on this platform. Thank you, Manoj Bhai.
એને તો સારું છે ને કોણ ને જેતુ ને હા એકદમ.
Over to you, Harish Bhai.
Thank you, Pritin. I now request CA Gautam Mota to present an e-memento to CA Manoj Shah.
On behalf of the entire CVOCA and all the participants present over here, Manoj Bhai, we would like to present this e-memento to you for taking the time out from your busy schedule and making us more knowledgeable on the subject. Thank you for accepting our invitation.
Thank you, Gautam. Now I request Manoj Shah to commence his presentation, please.
Yeah. Thank you, Pritin. Thanks everyone. I think firstly my compliments to Team CVO, Amit, and the Golden Jubilee Celebration Committee, for conceiving this idea to have this topic. I think topic assumes great significance. Meanwhile, it assumes great significance considering that there is too much flow of human capital, I would say, especially from country like India, where if you find that the number of students who are emigrating overseas for studies would have increased in large numbers, especially I would see even the undergrad students also. So you will find that the more and more countries across globe, especially country like Canada, UK, and US always welcomes students who would like to come to their country. Similarly, India having opened up its economy since 1990s, it is also making available to non-residents to make investments in India, and therefore the topic assumes great significance for the Indian diaspora who was residing abroad, who have created their wealth outside, and they would like to diverse their wealth to some extent to make investments in India, and maybe out of affection for motherland or kind of roots they have. Definitely there is a flow of capital to India. At the same time, you would like to see that how can one repatriate investments or wealth which is lying in India. Once you decide that we want to now settle permanently overseas, what are the ways in which you can repatriate your savings from India? So this is the topic which is there, and let me give you the brief of the overview or the kind of what topics we are going to discuss today. Just a minute. So these are the topics which we are going to discuss today. Initial part will be devoting something towards the basic concepts. Today the theme of today's topic also financial literacy. So I would request every NRIs, if I may say so, or those who are connected with this topic, even though you may find it little bit of theoretical part, but please pay attention, because this can have some sort of, you yourself will be kind of, you can become your financial doctor so far as your wealth is concerned. And therefore, I want you to pay some attention toward the scheme of taxation. What are the different residential status under Indian Income Tax Act? India has something very unique concept of resident, but not ordinary resident, which is not prevalent amongst many of the other countries. Then as Harish Bhai mentioned, there is something known as a residence under FEMA. So India still has a foreign exchange laws, and therefore one will have to also undertake or undergo what is foreign exchange management, and then how it operates and how it regulates the investments or flow of capital or flow of foreign exchange to and from India. Then interestingly, we will touch upon what are the investment opportunities for NRIs and overseas citizens of India. What sort of bank accounts or what sort of investments is possible, what sort of modus operandi is possible, which will be covered in the accounts for non-residents in India. And then what are the checklists, or what are the points when you emigrate out of India, and if you want to return to India, what are the again checklist for you. Taxation of income, we will run upon broadly what are the tax rates for the major category or most of the income which NRI would be earning, something like capital gain, something like dividend. So we'll touch upon these aspects. And then remittance facility, which I talked about, if you want to repatriate your wealth from India to your home country now, so for example, US, UK or Belgium or Qatar or Dubai. So these are the broad framework within which we will work. There is some issue with some presentation which is, I think, not visible on screen. That's why we are trying to manage this and
Now it's perfect. Yes.
स्क्रॉल हो रहा है?
No.
स्क्रॉल नहीं हो रहा है.
I think you have to share the entire desktop, not the PPT only. Then it will work, I think.
मैंने entire desktop ही share किया है.
पहले बराबर आ रहा था.
Is it okay now?
Now it's perfect. Yes, it's perfect.
Okay. So, the scheme of taxation, it is interesting to see some of the countries, how do they operate. Generally, you have, worldwide taxation and territorial taxation. These are the two broad categories of taxation which would any country or any nation would have it. So for example, country like USA, India, China, and most of the countries in the world would have this worldwide taxation. Now, what is worldwide taxation? Basically, it would say that, if you are residing in my country, I will tax you on your global income. Not only the income arising from the home country where you are residing, but even if you are earning something income from overseas country, wherever, we will tax you. So that is known as worldwide taxation, which is we call residence-based taxation. There is something known as a territorial taxation. That means that income only arising or accruing or you received in that country will only be taxable. And if the income is arising in other country or overseas jurisdiction, unless that income is repatriated back to the country where you are residing, it will not be taxable. Something like Singapore. So for example, a Singapore NRI, non-resident Indian who is working in Singapore with say Microsoft branch in Singapore or subsidiary in Singapore, and he has earned salary income from Singapore. Naturally, salary income would be taxable in Singapore, but he has parked his investment in India in say non-resident external account in Indian equity shares, and is earning dividend from India. Unless the dividend is taken back to Singapore, that won't be taxable in Singapore. So, he is kind of deferring the taxation in Singapore. Unless he repatriates that income to Singapore, that won't be taxable. So these are the broad two schemes of taxation. One is worldwide taxation and other is territorial taxation. Generally, by and large, as I mentioned, most of the country will have worldwide taxation. In fact, US goes one step ahead. US says that, if you are citizen of US, then we even don't mind where you are residing. So US citizen, even if he leaves the country and, comes back to India, still US will tax that citizen on his global income. So these are the different ways in which scheme of taxation works, but by and large, worldwide taxation and territorial taxation, and especially territorial taxation, or there are countries where there is no taxation. For example, UAE. UAE, Dubai, Abu Dhabi, all these Emirates have still not introduced taxation for individuals. There is tax which is likely to be introduced on corporates from June 23, but still not introduced for individual residing in this jurisdiction. And therefore, it does offer a lot of tax planning opportunities, and which is showing interesting opportunities for NRIs who are based in such jurisdictions. Let's understand this Singapore-based tax system, which is territorial-based. So there is a receipt in the hands of a Singapore resident, which is, you will have to divide that receipt firstly in the whether it is in the nature of revenue, what we call income, or is it in the nature of capital, something known as a loan. Assume for a while that a Singapore individual, he receives a loan. Naturally, it is a capital receipt and therefore not liable to tax. If it is a revenue receipt, you will examine what is the source. If it is Singapore source income, it will be taxable unless it is exempt. If it is source is a foreign source income, it will not be taxed in Singapore unless it is received in Singapore. That's what we saw. So this, having gone through this, basic concepts of taxation, now we go to the residential status under Indian Income Tax Act. Because India also follows residence-based taxation. That means that if you are a resident of India, your global income will be taxable. Similarly, if you are a resident of USA, your global income will be taxable, or worldwide income will be taxable. So US, UK, everywhere it will be worldwide taxation. We will more thrust upon what is the concept of residence. So if it is individual, it is generally goes with physical stay. There are some terms such as domicile, which shows the intention of person to stay in that particular country. So UK has something known as a more thrust on domicile. That is the residence where one has his permanent home, and to where and whenever he is absent, he intends to return. So domicile basically shows the intention. Intention does have some relevance even under FEMA, which we will see later on. As I mentioned, the Foreign Exchange Management Act, which talks about capital flow to and from India, also talks about residence. So far as income tax, Indian income tax is concerned, it is generally physical stay. Number of days that you spent in India will determine your residential status. For other entities, it could be, place of effective management or registration. So basically, if you see, how individual will be determined his residential status to decide whether his global income will be taxable or not, it is the physical presence. If you are a company, it is the place of management or incorporation. If you are a partnership firm, it is, where your control lies. The categories of residential status. Having said that, we have got, I'm touching upon the India part first, but more or less you will have under the every domestic law, say for example, US, UK, wherever there will be physical stay criteria given, and one will have to follow that to fall into the category, whether I'm resident or not. In India, basically, individual will be divided into three classes of residents. One is resident and ordinary resident, R and OR. Other is R but NOR, residents but not ordinary resident. And third is non-resident, where most of us, the audience which is there today, that is non-resident Indian, would be affected. This is the chart which you can later on go through. I'll not take you to the details. It is of the nuances because it is kindly complicated, and not just to say that India has such complicated laws. I think most of the countries in the world, especially US, will have more complex laws so far as tax goes. So that is basically about the number of days and what sort of exceptions you have. Now, just to touch upon the basic of taxation, is the period of stay in India. The ballpark number, to decide about residence in India is whether you are in India in a particular year, and when you say Indian year, it is April to March. Whether you are in India for 182 days or more in particular year, we call it previous year. So if I'm looking at, April 22 to March 23, under income tax parlance, it will be known as a previous year, and I have to see whether I was in India for 182 days or more to decide about my residential status. There is other condition also, 60 days and 365 days. But those who are new or do not want to get too complicated, please bear in mind that this provision of 60 and 365 days is generally applicable. I would say generally applicable when you are permanently returning to India. by and large, if you are leaving India in the year of departure, in the year of leaving India for employment or based on permanent residency visa, you will have to examine whether you were in India for 182 days or more. And that is how your status will be decided. As I mentioned, now touching upon resident and ordinary or resident but not ordinary resident. So R but NOR concept is that if you are non-resident, that means you are not stayed in India for 182 days in previous block of 10 years, and then that R but NOR status will be available to you for 2 years. We'll see, how it will be useful. So this could be a kind of golden period for you if you're coming back to India, and what sort of planning opportunities are possible, because in case of R but NOR, you are resident, but since you are not ordinary resident, your global income will not be taxable. What does this mean? That suppose, for example, a US NRI who comes back to India after having spent 15 or 20 years there, then for initial 2 years, based on that number of days criteria, he would be entitled to qualify himself as R but NOR. And moment he is R but NOR, his US income will not be taxable. His US passive income won't be taxable. Only income which is arising and accruing in India or received in India will be taxable. And that's why the importance of this status. This 182 days concept, which is there under Indian Income Tax Act, of late it has been noticed by the tax department that this facility of 182 days is being kind of misused, especially, people from India, the HNIs, what Harish Bhai mentioned about setting up family office or diversing the wealth to the other countries. People have, set up companies, and the 182 days facility, they keep on, shuttling between India and, say, for example, Dubai. And the 182 days is a quite large period to make himself available to family also, and, get attached to India also. So what they have done is that the period of 182 days has been reduced to 119 days. So what does this mean? That a non-resident Indian, if he says that, I am residing in country like UAE, only eligibility to qualify himself as NRI would be 119 days, and he cannot be in India for 181 days, which is otherwise available. What is the other criteria? That if such individual has income of 15 lakh, 1.5 million or more, again, the number of days get restricted to 119 days. Now, this 1.5 million income which I am referring to at this very juncture, let me mention that if you are earning NRE interest or FCNR interest, we will see these terms and what is the implication of this. But this is an exempt income in Indian income tax, and therefore this won't be counted. So basically, we are looking at 182 days criteria. There is some treaty benefit if you wish to even overcome this 119 days, but more or less the provision is just to get and give you an idea. When you are being aware that, 119 days is also something which is the newly introduced tax since last 2 years in Indian income tax. Otherwise, by and large, you are in India for 181 days, you can qualify as a non-resident. So resident and not ordinary status can be available for 2 years from the year in which you return to India. Overseas passive income of your such individual will not be taxable in India. And this can result into double non-taxation. How? What I'm saying is double non-taxation means you will not be taxed in the year on your passive income. For example, a person who was in US for say last 15 years, and assume for a while that he's not a citizen of US, and for some reason he's not even a green card holder, and he has been given ESOP of his company. Now he comes back to India. And after returning to India, this ESOP of the company, which is now listed on, say, NYSE, and he sells the ESOPs and makes a hefty capital gains, on this shares. Under Indian Income Tax Act, since he is enjoying the status of resident and not ordinary resident, this being an overseas income, this will not be taxable in India because the shares belong to US company. The shares are sold on US stock exchanges, and even proceeds are credited to those bank accounts. Even under the US domestic law, without even accessing India-US tax treaty, under the US domestic law, if you sell the shares of a listed entity, by and large, they don't tax such non-resident or alien, as they call it, and therefore this capital gain will suffer no tax either in India or even in US. So this is the possibility with which this R but NOR status assumes significance. Also, there is no requirement of disclosure of foreign assets in Indian income tax return. As you may be aware, the world over now there is a trend to make every citizen or every resident of particular country to disclose their all the overseas assets. So in India also, upon returning back to India, if you are holding foreign assets, it is a mandatory for one such individual to disclose in his income tax return whatever foreign asset that is holding. But if you are in this category of resident but not ordinary, such condition will not apply to you. What you have in US, something known as F bar and other disclosures, similar disclosures are there in India and even Indian income tax return. In fact, the disclosure of foreign assets has originated more from US. From 2008 financial crisis, the then president of US, Obama, introduced something known as a disclosure of foreign assets scheme, and that voluntary disclosure scheme ran for almost, I believe, 6 to 8 years, and a lot of tax was collected. It was made, the US residents were forced to disclose all their assets and pay tax on there, and the scheme went on for quite a number of years. So the world over, the trend is that we would like to all those residents of the country to disclose all the foreign assets and accordingly income. Again, just to touch upon what is the scope of income. If you are resident, as we know, entire global income is taxable. If you are resident but not ordinary resident, it is only income which is received in India or accruing or arising in India, and not the income which is accruing overseas. Unless there is business control from India, I'll not go into the details because not so much relevant for the time being. And if you are not non-resident, similar to R but NOR status, only income which will be taxable is the income arising in India. So if you're not non-resident, your US income won't be taxable. This is the interesting case which I'm trying to explain you the concept. And say, for example, we have now understood that a person would be treated as an ordinary resident if he's in India in that particular previous year for 182 days or more. Now, take an example of a person who has just left, in say December 22 for a job in US. And till prior to this 14 December 2022, he has never been to US, or this is the first time, he's going to, therefore he is resident, an ordinary resident. And his job has commenced from January. Now, the interesting issue would be, since he is resident of India, and therefore for the salary and the income for the period April 22 to March 23 would be liable to tax in India. So what happens to his salary which is earned during January to March 23? Will that salary be taxable in India because he was in India as an ordinary resident? And interestingly, since he has left India for employment and he is employed in US, say for example, he is employed with Apple or Alphabet, Apple will also make him taxable in US, and US follows the year of assessment as calendar year. So therefore, for calendar year 23, he is resident of US. So there is a common period, that is January to March, where he is dual resident. Because India follows April to March, therefore he is resident for January to March in India, and US follows calendar year, and therefore he is resident in US also. So is it mandatory for him to offer this 3 months salary in India? It is quite possible that the dollar salary which is receiving there, when it's converted to INR, it would lead to higher rate of taxation in India. Of course, he will claim a credit on whatever taxes that he has paid in US. But the point which we are trying to understand is this salary taxable in India for the 3 months what he is earning? Interestingly, recently there has been a case under Indian Income Tax Act where the taxpayer argued that I am dual resident, and now since I have shifted to US, the economic interests, my family or personal ties are all closer to US now. Therefore, I'm resident of US also for calendar year 23, and therefore the salary for January to March should not be taxable in India, and court did upheld his contention. And there is something known as a concept which is now emerging, that is split residency. This split residency, will arise in a case where the particular country where Indian resident who is now becoming NRI is following January to December kind of year. So it will be most of the European countries except UK, of course, because UK follows April to March, and therefore this facility may not be available. But otherwise, if there is a January to December calendar year, you can adopt that. Even in country like UAE, which follows January to December, and maybe there is no financial year or there's no year of assessment for individual, but you can very well argue based on your personal as I mentioned about the criteria, and which we will see in detail in few next slides, that you could be resident of UAE for this period, and therefore the salary which you are earning there won't be, there's no need to include that part in Indian income tax return. And this brings you to the concept of something known as a tax treaty or double tax avoidance agreement. So once you move to the country of out of India, and therefore you will have to bear in mind, or you will have to know this term, something known as a tax treaty or double tax avoidance agreement. The concept what I mentioned just now about the split residency is that you are dual resident of a country. So this gentleman who left India was dual resident for 3 months, but it is quite possible that you could be dual resident in future also, in the sense that since this country follows January to December calendar year, I mean year of assessment, India follows April to March. It is quite possible that you are spending 182 days in US also, or in UAE also, and 182 days in India also, or whatever are the number of days criteria which is described under the domestic law of US or such other country. And therefore it is quite possible that you become dual resident just on the basis of physical stay. But by applying this tax treaty, the whole purpose of tax treaty is that will determine that you should be resident of only one of the country. You cannot be dual resident. And what are the criteria to decide about the residence in particular country? By removing the other country, they call it tiebreaker test. So there is a tie between two countries, and we'll now to break the tie. How do you decide that? So first criteria is to decide about permanent home. Where is your permanent home? It is quite possible for a young person who has left India, he would say that, my home was there in India, but he would be even paying rent in US, for example, the case we saw, or the example which I gave. So it is not necessary that permanent home should be a home which is owned by you or by your family. Even a rental home is a permanent home. So you can say that if my permanent home is in US, and therefore I'm a resident there. If you have got permanent home in both the country, then the next criteria to break the tie is, where does lie the center of vital interest? Where your personal and economic relations are stronger. In the case which the Indian tribunal decided, the tax tribunal, the court which decided, that was a case of Singapore. And he said that, look, my salary is there in Singapore. I got my bank account, my credit card, my family is there. My children are studying in now Singapore school. And even I have started investing in Singapore. So my personal and economic ties both are strong in Singapore. So even though I've got house in India and house in Singapore, but since on this second criteria of center of vital interest, the tie fall back in favor of Singapore. If there is a center of vital interest in both the country, where is your habitual abode? Where do you frequently stay? That is, and the last criteria is nationality. Now, India does not permit dual citizenship, in the sense that you can't be resident of India as well as resident of US, but there are countries in Europe or other places where you could be dual citizen. If there is a dual citizenship, then the tax authorities of both the country will decide, not in the kind of relevant for today's topic, but just to give you an idea, this January to March part is quite useful, because it is quite possible that this 3 month salary, it could fall below threshold limit in the country where you are migrating, and therefore you won't be paying any tax there. But in India, because of including this salary along with your other income, your tax slab rate can go up quite higher. I'm trying to give you an example here, how do you treaty access for Indian immigrants, what are the criteria? Now, most of the countries, as we said about, they follow residence-based taxation. If it is a territorial base, again, the criteria for residence are given generally under the domestic act of every country. For example, Singapore, so Singapore Income Tax Act, CETA, or UAE, even though there is no tax, so there is a tax treaty, but every domestic law will specify criteria to determine residential status. So in most of the country where there is a residence-based taxation or worldwide taxation, the person or individual who has migrated will be liable to tax because of his residence or domicile. And therefore, US, UK, Netherlands, and Qatar, you can easily access the treaty based on this residence, because now you are resident of those countries. In case of UAE, since there is no tax on individual, and therefore he is not liable to tax, so there is no worldwide taxation. So what the Indian tax treaty says with respect to UAE based individuals, it says that if you are there for 183 days, you can access tax treaty. So that is what good point about the treaty got revised in 2012. And now, even though there is no tax in UAE, by virtue of being in UAE in the calendar year for 183 days or more, you can ask for tax residency certificate from the Ministry of Finance from UAE and access treaty, and therefore a lot of income which otherwise arising in India but may not be taxable in India based on this entitlement to tax treaty. That's some of the points to remember. This kind of checklist was, Harish also mentioned that, if you're emigrating, there are certain points which you can bear in mind. You can mitigate, plan your tax affairs in much better manner. And so therefore it says that in the first year of living India for employment, if you can leave before September 28, just to point which I mentioned, that if you're leaving before September 28, it would ensure that your physical stay in India would be for less than 182 days, and therefore you will become the income for that particular year won't be taxable in India. But the rescue will be the case law which we saw, that if it is a January to December kind of year of assessment in the home country, that could be relevant. In the following years, the person can visit up to total number of 181 days in India per year for Indian citizen and person of Indian origin. If, however, stay in India falls into different financial years, the number of days can get extended to 362. Person can come on 2nd October in the following year. But as I mentioned, that for this sort of planning is now kind of plugged with the reduced number of days. And if the income of such individual is exceeding 15 lakhs, then 181 days is now substituted with 119 days. During the last year abroad, if you plan to return back to India, your final return to India, try always to come back on or after 1st February, since return before this would result in exceeding 59 days, okay? Or if it is a leap year, 2nd February. This is what I mentioned about the first condition, about 60 and 365 days. I just take you back to the first very slide about which talked about the residence concept, which said that, 60 and 365 days. So this is about, final year of return. So if you are in India for 60 days in the relevant year, that is, say, for example, you come back in January 23, and your period of stay in preceding 4 years was 365 days or more, it can hit you, become a resident in India even in March 23, and your entire worldwide income can be taxable. But if you are not in India in 365 days or more in preceding 4 years, then you don't have to worry. You will be entitled to 181 days. You can just keep this concept in mind. There's no need to, apply this right now. This will just enable you to, apply whenever the occasion arises. Having, gone through this tax concept about residence and physical stay, and now we touch upon residential status under FEMA. The FEMA, as Harish Bhai also mentioned, basically India is a country, India being a developing economy, there are still some exchange control regulations or exchange laws, what we call the foreign exchange. Basically, the dollar denominated exchange reserve, which any government or any central bank would like to have. You may be aware about some of the countries, Asian economies like Sri Lanka, how they failed miserably when they didn't have any foreign exchange. Recently, even Pakistan is facing such issue. India was also facing such issue in 1990s, but thanks to liberalization and bold policies and the way Indian entrepreneurs and the Reserve Bank of India, particularly Central Bank of India, that is Reserve Bank, has fared so well that over the years, India is now today, comfortable on foreign exchange reserve. And that's why we have today FEMA, which is more liberalized version, the all, possible way, because all the NRI community, which is now growing every year by leaps and bounds, is just because that, we are quite comfortable on foreign exchange. That is the reason that we are able to afford such amount of foreign exchange, which any Indian resident would like to spend on studies or education or travel or, settling abroad. So when you look at FEMA, again, it is a residential is of two types: person resident in India and person resident outside India. So it is called PRII or PROI. Instead of NRI or this terms is not used under FEMA, legal term which is used is PRII or PROI. Here, when you look at FEMA, the primary condition for deciding residency is intention. So what is the purpose for which an individual has left India? That is going to be seen more with more focus rather than the physical stay. Physical stay has relevance, but a secondary condition. The primary condition to decide residency under FEMA is intention. So if somebody has left India for the purpose of employment or for the purpose of business or vocation, or in such circumstances, maybe for uncertain period, he is not left for business or not for employment, but the circumstances are such which would indicate that his intention was to stay abroad for uncertain period, then he could be regarded as a non-resident under FEMA. So that is what the concept is. The important part which we have to now discuss here is, the definition doesn't talk anything about students. So student is neither living for employment, even though his visa may permit him to study, or to work part-time for certain number of hours in university or based on rules, but his primary focus and the entitlement visa with which he is going is purely a student visa, and therefore he is not going for employment, nor is he going for business. And we can't say the student is left for uncertain period. Why? Because that visa is for limited period, and the visa is a basic document, primary document, which decides what is the intention of living India. So what do you do with student? Is he resident under FEMA? Is he non-resident under FEMA? Mind well, under Income Tax Act, he would be non-resident based on physical stay. But there could be a possibility that he is non-resident Indian under Income Tax Act, but for FEMA purpose, he could be resident. And that is practically can also happen. So three purpose for what I mentioned: employment, business, or any other purpose. That this graph which denotes that only. And you have to determine intention. The whole purpose of FEMA is intention based. Is that the example which I gave about January to March, somebody has left India on 14 December. The moment he leaves India with employment contract and employment visa, from that very day onwards, he would be regarded as a non-resident under FEMA. So 1st January, he takes up employment, he earns his salary, and he can have foreign currency bank account in, say, US. His salary can be credited there, and he need not bring back, or he should not repatriate, or he is under no obligation to remit that income to India. If he is treated as a resident under FEMA, then it is obligatory for every resident Indian to bring back foreign exchange, because the concept under FEMA is foreign exchange belongs to central government. Indian residents cannot own foreign exchange. They can earn it, but their obligation is to bring back and surrender it in exchange for rupees. So the whole purpose of FEMA being intention based is that it is a law to decide residential status on the day of taking transaction. So transaction is, what is the transaction under example? The transaction is under the example is about earning salary. So when the salary is earned, his status, it will be regarded as a non-resident, and non-resident, even not resident, even though he was in India for more than 180 days. Coming back to the case of students, the FEMA law is silent. As I said, definition doesn't give any clarity, but there is a circular of quite old circular of 2003, which says that, there's a discretion is given to student to decide for himself whether he wants to be regarded as a resident under FEMA or he wants to be regarded as a non-resident under FEMA. So if you see the bold part in the last paragraph, thus they can be treated as non-resident Indian. So if he doesn't want to be regarded as a non-resident under FEMA, he can continue with his residential status as a residence for Indian income tax for FEMA, and he need not change his bank accounts. We will see later on the obligation for becoming non-resident is that the Indian bank accounts have to be turned from normal savings account to non-resident ordinary account, and other options are possible. Those kind of compulsion, those kind of obligation will not be thrusted upon such student if he decides that I don't want to be declared as non-resident under FEMA. What are the investment opportunities for India? I mean, quite a number of, who would be interested in knowing what are the options available for investing in India. Of late, of course, the real estate market or even Indian equities and Indian mutual funds and have fared well. And there is a lot of interest now in Indian per se, India as a country per se. Not only that, India's balance sheet is improving as a country, but looks like, considering the present geopolitical situation, the post-COVID era, the post-Ukraine, or maybe the Ukraine-Russia war, the way India is emerging, probably it is offering a quite number of opportunities for overseas Indians to invest in India. At the same time, it also, shields from particular economy, shaking up. And one would have never thought that, Europe would face such a bad situation, which is happening now. So it makes all the more sense to, diversify your wealth and have something more in India. And that's what are the opportunities which permits non-resident Indians to make investment in India. First and foremost is the deposit with banks, because India being a growing economy, this kind of foreign currency deposit which NRI would be investing would naturally will fetch him quite an interesting rate of return which would be earned on such kind of deposit, which is FCNR, foreign currency non-resident account, non-resident external account, and non-resident ordinary account is an account which is a purely rupee account. Basically your savings in India, which is something known as you left India, and whatever are your assets in India or what is the bank balance in India has to be shifted to non-resident ordinary account. So basically this talks about investments in bank FD kind of. It is nothing but bank FD. NRE is a rupee account, but something known as a repatriable. Now, what do you mean by repatriable? Repatriable is a term which says that your money is available to you to move capital from India to your home country or wherever you want without any restriction. That is repatriability. And India has quite a free regime so far as repatriable investments are concerned, and FCNR and NRA represents that part. NRO is a non-repatriable account, but subject to again some facility which we'll see later. Every non-resident Indian can repatriate $1 million every year. So $1 million facilities available to repatriate from non-resident ordinary account, that is rupee savings, can be converted to foreign currency savings by withdrawing from India. $1 million, subject to certain tax compliance, subject to issuance of certain, filing certain form with income tax department, but that is possible. The another important aspect is investment in immovable properties. Except for agricultural land and farmhouses or plantation, NRIs are allowed to invest in residential and commercial properties. NRIs or even those Indians who have given up Indian citizenship and they have taken up citizenship of US or other country, so they would now be regarded as an overseas citizen of India. Prior to this OCI term coming into play, the concept was person of Indian origin. So those Indians who have given up their citizenship were regarded as a PIO, but now that concept is given a go by. So you have to be OCI or NRI. Mind well that OCI card, which is being issued, it is a must for making any investment in India, especially in equity and in immovable property. NRE and FCNR account can be opened even if you do not have OCI card, but for other investment, please ensure that you have OCI card, else your investment will be not in compliance with FEMA. The investment in immovable properties, if you see, it is available to NRI on repatriation basis also, and even on non-repatriation basis. The second column, which is talking about foreign company. Now, you will interestingly find that, most, and if you see the portfolio investment or the later on investment avenues, it is ticked or it is properly available, the route is available. But if you look at the immovable property part, the foreign companies are not allowed. Mind well, India has, even though in 1991 onwards, India has adopted the policy of opening up its sectors for foreign investment, the real estate sector or the investment in immovable property has always been restricted. It is available only to NRIs and OCIs, not available to foreign nationals, not available to foreign entities. So if you are a foreign national, not OCI, but foreign national or a foreign company, they cannot invest in immovable properties in India. And that's the reason you will find that the volatility which we see in Indian stock market or wherever, because that volatility is not there in Indian real estate market. The reason being that foreigners are not allowed to trade or invest in real estate. So you will never find that, what happened in 2008, like Lehman Brothers crisis, what happened in UAE or subprime crisis, as we know, which Lehman Brothers crisis, which just spilled over the entire world. The India was shielded just because of this policy of Reserve Bank of India that come what may, the real estate sector or housing sector or commercial property sector has never been offered to non-residents who are foreign national and foreign entities for investment. Otherwise, this could lead to speculative element and, this asset bubble could get created. So that's the policy which India has adopted even after liberalization, and it is not available to anyone except NRI and OCI. Then you have investment in portfolio scheme, which is listed shares and securities or mutual fund. You can have on repatriation basis also, and you can have on non-repatriation basis also. Investment in mutual funds, again, repatriation and non-repatriation basis. Investment in non-convertible debentures, which is available. NRIs and OCI can invest in only listed debentures. Investment in government securities of treasury bills and mutual funds, which are units of which basically debt related mutual funds. The investment in mutual funds, which we'll see later on about the tax impact and which Harish Bhai also touched upon, is quite interesting to see that investment in mutual fund, when you access the double tax avoidance agreement or tax treaty, the most of the tax treaty except USA and UK. Netherlands or even UAE or even Singapore, the capital gain earned on sale of mutual fund, be it short term or long term, that we sold within a period of 12 months or even lesser than that or more than that, it won't be taxable in India. Even though it is possible that tax withholding is done at the time of sale of mutual fund, but you can file a return and claim refund. We'll see that detail, later on, and quite interesting opportunity to maximize the return because there is no tax impact. Then there is also national certificate, national plan certificates, which is available for non-resident Indians and OCIs. The investment under FDI, then domestic investment, then investment in partnership, investment in LLP, these are all the business investment, I would say. So if you are an NRI and you want to invest something in India in a business venture, be it your family is in India and you want to become a partner in Indian business, or you want to start up, or whatever it's your choice, you want to park your investments, then you can do it as a business investment, what we call as a foreign direct investment. Basically, this is the investment, foreign direct investment, is in an unlisted company, or it could be listed also, but for the timing, for ease of understanding, because listed entity would be generally regarded as a portfolio investment. What we are looking here is that you want to become a shareholder in the company which will have some business in India. The India is offering quite interesting tax regime these days for manufacturing companies. It is only 15% tax. So if you are a new venture in India, it is just 15% tax, which is levied on the new companies which are set up as a private limited company on with a manufacturing activity. Then you can have partnership also is possible. You can be a partner in Indian partnership firm, and a refined version of partnership, that is limited liability partnership, which is a body corporate status it enjoys. The partnership has only one benefit, even though investment will be on non-repetition basis. The only single point of advantage with Indian partnership is that, say, for example, you are a US-based group of persons, maybe your friends or family, and you don't want any Indian investor, or you want entire ownership to be restricted only to your family. It is possible with normal partnership to say that all the partners will be non-resident of India. So there are 3 partners or 4 partners or 2 partners who would all be non-resident. The partnership firm would be registered in India, but the partners would all be non-resident. Under LLP or in the private limited company, entire shareholding can be with foreign company, or it could be a subsidiary, but one of the director has to be resident in India. And you don't want something secret business or something where don't want even one of the director to be resident of India, or in case of LLP, one of the partner who would be designated partner has to be resident of India. If you don't want that situation, this partnership firm's route can be explored. Of course, it has an unlimited liability so far as contractual obligation goes. But by and large, except you are guarantor to the bank or somewhere else, I don't think there is any exposure required. And this partnership has some sort of significance only for the limited purpose. We go further on this. What about loans? I think loans is something very sensitive when it comes to Foreign Exchange Management Act, and therefore borrowing from non-resident is something Reserve Bank has very strict policy for that. So what is the possibility for NRI if they wish to give loan? It is again only interest-free loan, which to close relative under US dollar 250,000 scheme. The relative would be defined under the Indian Companies Act, and it is a very restricted definition. It may be lineal, ascendant, descendant, but loan can be taken by resident Indian from relatives. And if you are a shareholder of a company, something which I talked about, business loan, if you wish to give to the company where you are a shareholder and holding 25% equity or more, and you would like to earn interest on this debt which you want to give, then you can give loan, which is known as external commercial borrowing. So far as Indian company is concerned, it has raised fund externally in foreign currency, and that is what it says. So it offers you something like international benchmark rate plus 550 basis points. So something like maybe around, in foreign currency terms, you can earn something around 6%, provided it is your own company. I would say own company in the sense that you are owning at least 25% equity, and then as a shareholder you are giving a loan, which is possible. Otherwise, debt by and large is not possible. Whatever debt is possible is through bank FD or other debentures, or those kind of listed instrument, or which are more regulated. But private borrowing is not permitted, and the reason being that the private borrowing, if it is allowed, it can lead to asset bubble. It is quite possible that every any growing economy, will have higher rate of interest. Something assume, for example, finance companies. Today, if the finance companies are allowed to borrow freely without any restriction from non-residents or from overseas market, there would be flow of capital or flow of borrowings in India, and this will be again re-lending would happen, and this has a possibility of spiral effect which can lead to asset bubble, and therefore there's a very strict regime on borrowing. So even though you're becoming partner in partnership firm or you're becoming partner in LLP, though Indian Income Tax Act permits some sort of rate of interest payment, avoid so far as this is concerned from FEMA perspective. We'll now see some of the bank deposits and accounts for NRIs in India. What are the salient features? We'll maybe just run through quickly. You can browse through even internet also. Most of the banks will have such sort of facilities so far as there could be section on their website or about NRIs and what sort of incentives are available. So you have NRE and NRO account. As I mentioned, it is a non-resident external account and non-resident ordinary account. It is an account of NRI to transfer foreign earnings to India. NRI is to manage income earned in India. Basically, whatever is your income earned in India, or you can repatriate or remit funds from overseas also, but it will be non-repatriable and basically meant for domestic spendings or domestic investment. Interest earned on NRE is tax-free, whereas interest earned on NRO is taxable. Deposit and withdrawals are possible in Indian currency. The NRO will always be in Indian currency. NRE would be deposit in foreign currency also and withdraw in Indian currency also. You can remit funds to India. Both the accounts can have remittance from in foreign currency, but so far as NRE is concerned, NRE will be rupee account. We'll see FCNR in next slide. What is the FCNR deposit and repatriation? Since non-resident external is fully repatriable, there is no condition, there is no limit on repatriability. So far as NRO account is concerned, balance in NRO can be repatriated, as I mentioned, up to $1 million in a year. The interest on NRO can be freely repatriated. If you want entire balances and interest can be repatriated. Now look at the broader scheme about investment, non-resident ordinary, non-resident external, and foreign currency account. So FCNRB is a foreign currency deposit. The interesting, part of this slide is that if you see that these deposits are available to be offered as a security. So if you have got a FCNR deposit, you can pledge it. And this pledge can be, that our deposit will be pledged as a security, and the Indian resident can borrow against that. So therefore, example, when we say that borrowing by Indian residents from non-resident is not possible, but if such NRI is placing a deposit in FCNR, this FCNR deposit can be offered as a security to an Indian LLP or Indian private limited company, and that the transaction of borrowing will be between the Indian company and the domestic bank, right? So this last leg of transaction of borrowing based on the security of FCNR deposit or NRA deposit is in Indian rupee, and therefore the Foreign Exchange Management Law Act doesn't get triggered in. The FEMA itself makes it clear that either the depositor himself, that is he himself also can borrow against this deposit, or even third party can borrow. So this offers a good opportunity for non-resident Indians to place a deposit in FCNR account in India, against which Indian entity can borrow. In fact, it does also offer an opportunity for NRI to again borrow in home country or to a third party overseas. So you can have a bank which is, something, say, for example, I'm just giving example, you say ICICI Bank, you place a deposit with ICICI Bank, especially it can work wonders with country like UAE or Singapore. As I mentioned, in Singapore, you don't pay tax on NRE or FCNR interest unless it is repatriated back to Singapore. So a Singapore NRI, places a deposit, which is FCNR deposit, and this deposit earns interest, which will be tax-free in India. And since it's not repatriating back to Singapore, that won't be taxable in Singapore. Now, this deposit can be offered as a security. There could be borrowing in India. This deposit can also be offered to overseas borrowers. So something in whichever country, which the banking framework permits or whatever is the procedure required. And therefore, this sort of debt funding is indirectly possible by virtue of this accounts. Some of the nuances you can run through these slides later on also. I'm not going to detail for paucity of time. I think we can spend more time on actual Q&A which you have, but this otherwise is a self-explanatory and quite a simple to follow. Yeah, loan to account holders, the point which I touched upon. Loan to third parties, that is also, which we touched upon. Change of residential status. So if you are becoming resident in India, after you come back to India, as we mentioned, and you coming back to India is for permanent. So if you are on a visit to India, this provision will not apply. What matters under FEMA is intention. So again, I mentioned, say for example, a period of COVID, somebody was in India and he couldn't go back. So that is not the purpose of coming back to India. He is in India, but his intention is to go back, and whatever is the moment COVID restrictions were lifted, he will go back to his home country. So in such circumstances, he need not convert his bank accounts to normal bank account, which is savings account or current account. But otherwise, moment you come back to India with intention to permanently settle in India, non-resident external account either has to be closed and converted to rupee account, or he can convert NRE, which is an external repeatable account, to something known as a RFC account, which is resident foreign currency account. Even that facility is available for FCNR account. And this is again quite interesting because resident foreign currency account is an account which is available, which will be maintained in India, but in foreign currency. So if you want to say that, I just want to earn or want to keep my wealth in foreign currency, even if after returning to India, and you don't want to park in something like Silicon Valley Bank, which what happened, we all know. And therefore you find that Indian banks are much more safer. Let me bring back that funds to India, but I don't want it to be converted to rupee. Because in future, I don't know, 5-10 years down the line, I would like to go back, or my family or my children are still there, and I would like to give them foreign currency. So RFC offers a good opportunity. You bring back your wealth, park it here, make it in RFC, and then RFC account will give you interest also. That interest will be tax exempt only till the time you enjoy the status of resident, but not ordinary resident. Once you become resident, it will be taxable in India. But it does offer a good opportunity to maintain foreign investment. Now let's look at, emigrating Indians. So as we know that the foreign exchange management is now quite liberalized version of what we have in India. The predecessors of the version of the foreign exchange was Foreign Exchange Regulation Act and the of 73 and 47, which were quite restrictive. But there's some disturbance. If somebody can, just yeah. So basically it says that, once a person becomes non-resident Indian, you are living India, you are emigrating Indian, it says that you can continue to own your Indian assets. So there is no need to, wind up all your assets in India and close the business, except that, if you have got agricultural land in India, you can continue to own the land, but cultivation is not permitted. Otherwise, all your assets, be it home, be it equity shares, mutual fund, jewelry, paintings, bullions, everything can be continued without any restrictions. And if the law or the language used in FEMA says that, you can only continue with 3 classes of assets, which is foreign currency, security, Indian currency, security, and immovable property. But it is now quite clear that all other assets, can be continued. So far as crypto is concerned, you're holding it in India, you can continue, no need to liquidate that. But crypto is a class of asset which Reserve Bank of India or the India is quite averse to allowing its residents to hold crypto. We'll see for returning Indian what can be done with crypto. Bank account, if you're leaving India, then it is mandatory that you redesignate your account, your savings account, to non-resident ordinary account. Okay, and if you are having EFC account, which is exchange earners foreign currency account, or you have got RFC domestic account, that balance can be credited to non-resident external account or FCNR account. But your basic intention is that your savings account in India, which you are holding, you need to convert it to non-resident ordinary account. You may take certain reasonable period of time. It is not that you have left immediately, you want to convert it, but there are no reporting like what you have under income tax. Every year you file return of income. Under Foreign Exchange Management Act, there is no filing, there are no reportings. So therefore, the Reserve Bank of India or any other regulator or authorized dealer, as we call it, they are not going to come to you and tell that you have not done that, converted a bank account. And therefore, by and large, we have not seen any penal action being taken. But there are 2 or 3 compounding orders where the person who turned NRI and he did not convert his bank account to NRO account. And one is the case of this compounding authority application number 4859, when he made investment out of normal savings account into the company. So which was an unlisted investment or something known as a domestic investment in private limited company. And even though he was NRI, he should have made investment from NRO account. He made investment from savings account, and there is a compounding order. The second compounding order talks about, he transferred funds from NRI to ordinary savings account, and he gave loan to his friend. So he had an NRI account. The other account should have been, in accordance with the law, should have been NRO. But what happened? He continued with savings account, and he transferred fund from NRE account to savings account, and from savings account he gave loan to his friend of his. Now, borrowing, as I mentioned, is not allowed, direct borrowing. He gave a loan to that person, and his friend even paid him 6% interest and everything. Then, this is contravention of FEMA, and borrowing is also not allowed. And there's a compounding order to that effect. So please ensure that, you convert this savings account to NRO account. You intimate about your, whatever assets are in India, like Demat account or even mutual fund, you intimate that I have now become NRI. And therefore, please make it non-repeatable investment. Whatever investment which you are holding up to the date of becoming NRI will be treated as a non-repeatable investment. You can continue with your Demat account, even debt instrument, everything can be continued. As I mentioned, there's no need to, liquidate anything. Even LIC policies can be continued. In fact, if you are living in India and if you find that there are some good insurance product available, life insurance or term insurance plans, please ensure that before you leave, you take good amount of policy. Because after going to certain, countries, it will be very difficult to get policies or insurance, especially life insurance policies. And therefore, it is always advisable that before you leave, if you wish to, insure yourself, especially for term plan, all that, make sure that you take all the insurance policies, and that is continued regularly. Even I would like to stress upon even Mediclaim policy that, Indians who are living, they should have some Mediclaim from India perspective also. They should continue to have some Mediclaim in India, because we have seen sometimes, returning Indians, especially senior citizens, or even these days, because you don't not sure of what sort of health issues could crop up. And when you are in India with no Mediclaim, it can become a costly affair. So it is better even to continue with Mediclaim in India before departure and continue with that policy forever. PPF account, you can continue PPF account up to the period of 15 years expiry, and you can even contribute that 1,50,000 maximum amount which is available for investment. So far as employee provident fund is there, though it is not my forte, I am told, by my professional friends who deal in this law, that you can continue employee provident fund till the age of 58. If you are near the age of 55, 56, then they say that you can continue for a period of 3 years, and post that it become inoperative. So even interest will be earned on this EPF account. That interest, of course, will be taxable if you are not employed in India. So that is what is about EPF. The foreign currency investment made outside India under liberalized remittance scheme and ODI. So as a resident Indian, you had made investment overseas. That is what is it talking about. And LRS stands for liberalized remittance scheme. I touch upon that scheme in detail in some time. But the point here is that, whatever investment you have made in foreign company, be it as a private equity investor or as a business investment, what we call overseas direct investment, that can be continued. You need to, in fact, inform Reserve Bank of India that I have now become NRI, and therefore my business investment in unlisted entities or the business investment will no longer be regarded as an overseas direct investment from India, and you need to cancel what is known as a unique identification number if it is allotted to you. We now look at the gift transactions. What sort of gift possible, so far as Indian assets are concerned. And this could be gift from resident of India to non-resident Indian, or even can non-resident, even though he's owning Indian assets in India, can he gift? So what are the permutation combination possible? So first look at equity instrument. I'm using the word equity instrument because that is what is term which is used here in FEMA when you look at the foreign direct investment regulations, and that's where the equity instrument is defined. So it says if resident is a donor and non-resident is a donee, that means resident is wants to give shares to non-resident Indian. For example, father is a resident Indian. He wants to give a Demat shares, which is listed entity shares, to non-resident Indian. The regulation says that it requires prior approval. The resident to non-resident gift is under prior approval, again with a lot of restrictions. But recently we had a case where I will not like to take the name of the authorized dealer or the depository. But since the investment which will be held by non-resident Indian, even on non-repetition basis, they simply transferred the investment from resident to non-resident. So this gift otherwise is under approval route, as I mentioned. The shares, of held of listed entities or even unlisted entities, private limited companies or limited companies would require prior approval. If non-resident is wanting to gift shares to resident, it is permissible, it is allowed. Between two NRIs, that is also permissible. So, those non-repetition investment would be possible. Even repeatable investment would be possible. Mutual fund units, there is no reference under Foreign Exchange Management Act about this, but I believe that, if it is resident to non-resident, it is advisable to take approval of Reserve Bank of India. If it is non-resident is wishing to give mutual fund units to resident, it will be permissible. Immovable property, other than agriculture, plantation, and farmhouse. If resident wants to give commercial or residential property to NRI, it will be allowed. If it is agricultural land and there's a land which is owned in India, and you will not be able to give gift without prior approval of RBI. So resident can give residential or commercial property to NRI. Between two NRI also, the gift of Indian property is possible, and NRI to resident is also possible. So that is not an issue. Now let's look at gift of foreign assets. What are the possibility of foreign assets being gifted? So you have foreign securities, whether foreign shares or other securities can be gifted. So if non-resident is a donor and recipient is a resident, then it is permissible. Now subject to certain additional compliance under FCRA, that is Foreign Contribution Regulation Act, but it's not very cumbersome process. And this gift is possible. So if you're owning a shares of foreign listed entities, Apple or Microsoft, or you want to give gift, you can definitely give. Between two resident, it is available. Two residents also can give gift of foreign security. So if somebody has acquired shares of listed entity under liberalized remittance scheme of $250,000 and he wants to gift it to resident, but it should be within relatives, otherwise it will require approval of Reserve Bank. Resident to non-resident gift will again require approval of Reserve Bank of India. Inheritance of foreign security. Inheritance should otherwise be permissible. So therefore, non-resident bequeathing shares to resident or even resident bequeathing shares to resident should always be possible. Resident can also bequeath to non-resident. I mean, you can't stop inheritance, but somehow the reference under FEMA is not available, and therefore I have mentioned, not covered by general permission. To my knowledge, and you cannot stop somebody from giving to anyone. It could be even foreign national. Interestingly, immovable property situated outside India, what happens? So you have a house in US or UK and you want to gift it to somebody who is in India, I mean resident of India. Can you gift it? The law says no. Non-resident to resident gift of overseas property will require prior RBI approval. And in fact, this was a transaction which actually happened in our office. And we sought approval from the Reserve Bank of India New Delhi office, because the immovable property division is handled by New Delhi office, and the transaction had to undergo panel provisions, of course. So if there is a gift which is to be done by non-resident to resident, it will require parallel approval of RBI. Interestingly, between two residents, gift is possible. So if a resident has acquired property under LRS, of $250,000, he can gift it to resident in India. That's possible. But resident to non-resident, again, it will require approval of RBI. Inheritance from non-resident to resident is always under approval route, and that's what is the law. Now let's look at returning Indians. We saw the emigrating Indians, and now let's touch upon what is possible. So you come back to India, somebody has come back to India, and then what happens to his overseas asset? The main question is, can you continue with your overseas assets? And as I mentioned about India assets, the same is the case with overseas assets. You can continue with your foreign security, your foreign house, your foreign jewelry, paintings, car, and whatever asset that you've created, you can continue with that. Coming back to crypto, I mean, you cannot, since you're created this virtual digital asset, as we call it in India, VDA, or maybe crypto or whatever you call it. Those kind of assets can be held by such individual when you come back to India. But mind well that no further investment to be done from India. If you sell it, you bring such realized back to India. The India's policy on crypto is quite strict, and rightly so, I believe, because a lot of what you call the transactions which are anti-social or not in the interest from the security perspective, a lot of drug money or weapons or illegal weaponization is happening through crypto, and settlement is done in crypto, and therefore India is very strict with this crypto. So if you are holding crypto, just keep it there. Don't make fresh investment from India after coming back to India. So that is what is required. Even though you can have foreign money and you can play with that, I mean, you can make additional investment, but if you can refrain from doing so, it is advisable. Bank accounts, you can continue to own foreign bank accounts and you can continue with that. No need to close the account. In India, as I mentioned, NRI and NRO should be redesignated, which you've already seen. The foreign bank accounts can be continued, but so far as income which is arising on foreign, if I say, investments income can be parked in this foreign bank account. Whatever investments were held prior to coming back to India, you are owning shares or other investment and you're earning dividend and you're buying and selling shares, those can be parked there. But if there is a regular income, something like pension, you need to bring it back to India. And now with the recent, from August 24th, 2022, it has become mandatory even under liberalized remittance scheme or wherever there is investment going abroad. If these funds are remaining idle, if the funds are not utilized within a period of 180 days, those funds need to be brought back to India. The reason being that we also the volatility in forex market, the dollar, which was otherwise prevailing around 69.70, has suddenly gone up to 80.82, and therefore Reserve Bank says that if you are not parking, I mean, you just simply can't park money overseas. If there is no investment avenue available to you and you have kept your money, you will have to bring back within 180 days. LIC policies can be taken outside India, which was there. You can continue, but once you are back to India, you can't take fresh policy. So even if there could be unit linked insurance plan, something like what is available in India, or there's some good investment opportunity which is available by way of insurance product, once you are back to India, even though you do not want to repatriate funds from India to buy that insurance product, that won't be permissible. The Insurance Regulatory Development Authority, IRDA, is quite strict with that, to say that once you are resident of India, if you wish to buy product, you have to be Indian insurer only, not from foreign insurers. But those policies, when they are getting matured, you will have to bring back the maturity proceeds to India. As I mentioned, resident foreign currency account, this opens up a good opportunity. The funds which are lying in India in NRE and FCNR can be parked in RFC account. These funds are available in addition to your $250,000 limit. Once you are to India and you want to remit funds overseas, in addition to your overseas funds which is there, if you wish to make Indian investments abroad, restriction will not apply to this account. The list of permissible credits is given, which is what I mentioned about received as pension or any other superannuation. So if you are coming back to India and you want to hold if you're earning pension from, your employer from overseas, you can park in RFC account. Resident foreign currency account, as we continue, there is something interesting, which is resident foreign currency domestic account. Now, this domestic account is, visibly available to, as the name suggests, to any resident individual. So for example, there is a son who is earning, he wants to give say $1 lakh to his father in India. That $1 lakh can be parked in this RFC domestic account. This will be retained in foreign currency. So this is what is the plus point of this thing, that if you wish to hold something foreign assets in India, you can. Let's now just touch upon some of the tax provisions of various incomes, and if it is a capital gain which is arising on residential or commercial property, if it is a long term, it will be 20%. If it is a short term, it will run through your normal income, and based on the slab rates, it will be taxable. The listed equity, if it is sold in stock market, recognized stock exchange as we call it, with security transaction tax, STT, it is 10% or 15%, and equity oriented mutual fund. So these are the kind of tax rate which will be liable to pay. Coming back to mutual fund, which I said, if you can access treaty based on tax residency certificate, especially country like UAE, where there is no tax, if you are selling shares of mutual fund, units of mutual fund, you will not be paying tax in India based on treaty entitlement, based on the tax residency certificate, and even Netherlands or even Singapore. And Singapore under even domestic law. So Singapore also doesn't have capital gain taxation at all. So these are the countries where, Singapore and US will not be paying any tax on sale of mutual funds. And if you look at the returns on mutual fund are in terms of at least rupee terms, they are quite attractive. At least, double-digit returns are till now it is available, and therefore it makes sense to be there invested in mutual fund and earn tax-free return. If you are selling a immobile property, then the buyer as a resident buyer is under obligation to withhold 20% tax on gross consideration. The entire sale transaction, he is liable to deduct tax. So therefore, generally what we suggest to non-resident, who sell the property, that we can approach tax office in India and obtain a lower TDS certificate. And the procedure, generally takes kind of 30 to 40 days to, obtain this certificate. But it is possible to get such things, and therefore it is always possible you try to meet your tax consultant in India and then plan it affairs that this is transaction which is likely to take place. We are going to sell the property and make proper transaction feasible so that you can bring back the tax liability of TDS, which is up to 3 to 4%. And there are other investment opportunities available to even NRIs. If you are selling one house and buying another, again exemption is available. So all these possibilities are there, but just for your knowledge purpose that otherwise resident buyer is under obligation to withhold 20% tax. You can reduce it by approaching or obtaining lower TDS certificate from tax department. There is some view available that even chartered accountants in India can issue such certificate. Technically in league, I mean, if you read the Income Tax Act, yes, but we as a practice always try to follow the departmental process so far as immobile properties are concerned. Repatriation of immobile property, again, just to give up emphasis that even NRIs are not allowed to trade in real estate. So if you are coming as an individual, you can't say that I'm buying 50 units in one building and then trying to sell on a retail basis. I bought under construction, then I'm selling like a retailer. That's not possible. So you can make investment in immobile properties in India, and appropriate time on a long-term basis you can sell it also. And the sale of residential property, if you have made investment from NRE account or by liquidation of FCNR deposits, then that will be regarded as a repatriable investment. You can repatriate sale proceeds of 2 residential properties. And if excess properties are there, the money of such sale proceeds will be parked in your non-resident ordinary account. And from NRO account, you can repatriate up to $1 million scheme. This restriction of 2 property will not apply to commercial properties. Some of the other noteworthy provisions which are related to NRI, that if you are a resident based out of Singapore, UAE, and Netherlands, capital gains, as I mentioned, of mutual fund will not be taxable. To claim benefits of tax treaties, tax residency certificate is required, and especially you can write to your tax office in I think Singapore has a detailed TRC rules, and most of the countries have such TRC rules, and if you apply, you will get within reasonable time to get this TRC, so that can be produced to chartered accountant when you are repatriating the income, or even to banker, so that there is the transition of repatriation from India to your home country becomes very smooth. These are all the provisions which you can just touch upon later on. Yeah, something about investment by US based NRIs in mutual fund. So there is some view prevalent that even the appreciation in the net asset value of mutual fund is liable to tax, even if it is not sold. So say, for example, you invested in mutual funds in India of, say, ICICI Prudential and particular large cap or mid cap or whatever schemes, and that appreciation is there from you invested as on March in India being the last date. So whatever is the or December, let's take it December, because you are following in tech, you're liable to tax on global basis in US. So on December 22, there is an appreciation in the value of mutual fund. Is it liable, even though you're not sold? So unrealized gain, whether it is liable to tax in US. So to our understanding, even though we are not practicing US taxation so deeply, but whatever is our limited knowledge, that is not taxable if you are a direct investor. As a US NRI, if you are a retail investor in mutual fund and individual capacity, this provision will not apply. That only applies about unrealized gain taxation is to, PFIC, as they call it, PFIC, that is passive foreign investment company. So US based residents, they float a company which is PFIC company, and that company in turn invests into emerging markets or wherever other markets, and they earn gain. And what they do is they do not liquidate those, they do not declare dividend. nor they bring any income back to US. And therefore, such type of companies, if the investment is rooted to such companies, then those unrealized gains are liable to tax. But to our knowledge, the simpliciter investment made by US based NRIs in mutual fund, and even if there's an appreciation, you are not sold the mutual funds, that should not be liable to tax. Upon sale of mutual fund, of course, so far as US and UK is concerned, both the country will make it liable to tax. So India will also tax it and US will also tax it. But whatever taxes are paid in India, while you file your return in US, you will be able to claim credit for the same. These are some of the tax rates for other sorts of income. You have got a business income in India. If you are running a partnership or a proprietary concern in India, it will be a tax rate. Dividend income is again at regular slab rates. NRE, as we mentioned, it is tax exempt. FCNR is tax exempt. NRO is taxable. Now, something about importance of documentation for establishing foreign income as a source of Indian wealth. So especially, generally recently with this, data between the countries are now flowing very freely. Something that is known as AEOI, Automatic Exchange of Information. Like US have a FATCA. Similarly, Indian tax authorities are able to access all the tax records wherever required, if of NRIs. So there is free flow of information between across economies, and therefore it makes it mandatory that whenever you are creating assets in India, you will have to, Indian tax authorities can also question, what is the source of having these investments in India. You can't say that I got NRE deposit in India, which is I was in US for 20 years and therefore I got this money in India worth say a few billions or few $1 billion. So the source needs to be proved. So what could be done? If you are coming from a jurisdiction like US, UK, and Singapore, where the tax filings are mandatory, probably your tax returns, your employment certificate and remuneration will make you entitled to, establish the wealth. But if you're in a country like, UAE, there's no taxation. So what we advise is that, you please prepare your net worth statement every year. You can decide, maybe if you are in UAE, since there is no tax, instead of December, you can reconcile that with Indian previous year or Indian financial year. April to March, make your net worth statement, your income statement, your income computation, your wealth statement every year and get it certified by CPA of UAE. That will establish that you have earned salary, you have got your income, your investments, and whatever is there. So far as your UAE balance sheet is concerned, your financial affairs are concerned, get it net worth certified statement. And those statements on a year-to-year basis will make you your life easy when you come back to India and you suddenly bring back huge amount of money. That these are my source, this is my valid bank statements which are there, supported with duly audited statement or net worth certified statement. So that is mandatory. So far as other economies are concerned, especially when you're filing return of income, of course, that makes it easy for you. But there have been cases, reported cases, where people have misused this facility. Some of the time it has happened that we had a case on, there's a reported case where somebody was, one became overseas citizen of India. He gave up Indian citizenship and he took up US citizenship. But since Indian passport was still available with him, so he opened an account with Indian passport in Swiss bank. And this Swiss bank account was neither reported to US tax authorities nor reported to India tax authorities. And this money was, these details were leaked in Panama paper link or other things. And now this, as I mentioned, there is a lot of information which is otherwise available to tax department. They are more savvy on technology than what we believe. And the big data which is available to them is much, much more enormous than what we can even think of. So on a finger press of a single key, the kind of detail which tax department is able to gather across world, is just phenomenal. So make sure that you are factually correct. Maintain proper records of every income that you have, especially in the country where there is a low tax jurisdiction or no tax jurisdiction. And whenever you are making investment in India, support it with proper documentation. Because if you wish to remit back money from India to overseas, those questions again will be questioned in India also. Now these days, even the bankers in India keep on questioning that what is the source of investment in India if you wish to repatriate to your home country under $1 million scheme. And you can't here say that, my investment was 10 years old, 12 years old. You will have to establish. So therefore, proper return filing in India is also kind of very, very important. Just few moments on, liberalized remittance scheme, which is 250,000 scheme available to resident individual. You can invest even in unlisted companies. I think I'll just rush through this $1 billion scheme I've already touched upon, and I'll keep your house open for questions. I think I thank my team, CA Viral Satra, my partner, Tanvi and Kevin Vora for helping me in making this presentation. Thank you, friends. Thank you for listening to me. Thanks.
Yeah, Manoj, that was an excellent presentation. And within this short duration, I will say that you have covered so many things. Many thanks to you for your extensive covering and your excellent presentation too. Now,
Thank you.
as I go to the questions which have been compiled by the CVOCA team, I don't know whether you would like to answer this question. The question says that when we have to file FBAR and FATCA, and where do we have to file these forms?
So as I mentioned, we don't practice US laws so strictly, but FBAR is a very old regime and FBAR is a separate filing, and FATCA also is a disclosure requirement more to, Indian or bank accounts or Indian mutual fund and this thing. But your foreign assets are also required to be disclosed to your US IRS. That is what is the scheme is. So you need to approach your CPA, but suffice to FBAR and disclosure of Indian assets.
Okay.
Question
Manlaj, there is some disturbance. So if some
Yeah, we will move them.
Yeah. Then what is the difference between
Put it on a chat box. We will take up those questions then. Harish bhai, you're on mute. Harish bhai, you're on mute.
So what is the difference between NRE account and an NRO account? And what are the restrictions with regard to deposits and withdrawals within India and remitting and repatriation?
So as I mentioned, NRE per se is a repatriable account, and non-resident ordinary account is a non-repatriable account. So what happens when somebody leaves India for employment, whatever are his Indian assets, so bank balance or mutual fund or everything, will get the character of non-repatriable investment. That means that sale proceeds of this or money lying in Indian savings bank account cannot be taken to overseas country. But India, having developed, good amount of foreign exchange reserve, India introduced this scheme, something known as a $1 million scheme. So non-resident ordinary account is an account which basically is a non-repatriable account. Money will remain in India only. If you wish to repatriate, you take it under $1 million scheme, subject to payment of taxes on all the credits which are there in the bank account. NRE is repatriable account. So NRE will basically mean that you remitted funds from abroad. Whatever your earnings, you want to wish to invest in India, you can remit from overseas and park it in NRE account. From NRE, you can buy immovable property. From NRE, you can start an SIP. You can invest in portfolio under investment scheme. You can invest as a foreign direct investment also. You can invest in LLP also. You can invest in partnership also. Partnership will be always non-repatriable, but LLP or FDI or immovable property, as I mentioned, up to 2 residents can be repatriable. Commercial always can be repatriable. So these are the possible. So basically, NRE is a remittance from abroad. And NRO represents domestic account. It can also have remittance from abroad. But moment you park your money in NRO account, that money will not be easily available for taking it away from India.
If I'm a resident of India, can I hold foreign currency accounts outside India? That is bank account in Canada or USA?
No, you cannot own. You can remit under liberalized remittance scheme, and then you can make your investment there. But as I mentioned recently, from August 24th onwards, if there's no avenue available for you to invest, merely opening a bank account and keeping money there is not an eligible purpose for liberalized remittance scheme. There have been recently, from few days back only, in the Economic Times of India, there was a big article, which these said that, the large HNI families are under, search where to invest money, because now there is a requirement to bring back that money. If it is not remaining utilized, then you have to bring back that money back to India, and you will lose the limit of $250,000. So the only debatable point, which arises is, they say that, if you wish to invest overseas, you have to invest in a listed debt instrument or listed securities. Now the issue is, can I park money in bank fixed deposit of US or whichever country? So whether bank fixed deposit, is it an eligible mode of investment? That's a debate which is going on amongst professionals also these days, that, if I park in bank FD, is it valid investment which I have made in a liberalized remittance scheme? To my view, it is kind of debatable, and therefore, if you are not, you can't simply hold money. See, foreign exchange belongs to central government. India will be very, very sensitive. So just for the sake of keeping an account open and holding it, it is not permitted. You can open an account and have some minimum balance. That's not an issue. But if there is no purpose of investment, you will have to bring back money back to India. So opening account under liberalized remittance scheme as resident, yes. But if you are earning any income, there have been cases where quite young entrepreneurs, I would say, or young individuals, who are professionals, are able to, earn e-commerce income, whatever, maybe professional rendering service, and, you park that money cannot be parked overseas. Those income have to be repatriated back to India. So that is the purpose.
Okay. They are asking, is TDS applicable on PIS, non-PIS account? Perhaps they are wishing to ask that on sale of shares, whether there would be TDS.
Yeah, on repatriable PIS account. Yeah, PIS account repatriable, yes, of course, there will be TDS.
I am currently a student in Europe, and before going abroad, I had 4 Indian bank accounts. But I converted only one bank account to NRI NRO, but the rest 3 are still my savings account. So what is my status and what should I do in future?
Yeah, status definitely. If you, as I mentioned, student is got a, Gujarati ma kahiye to dudh ma pan pak chhe na dahi ma pan pak chhe. You have to decide yourself whether you want to regard yourself as an NRI or not. If you wish to be continued as resident, then you can continue with, normal savings account. But the problem with your case is that, you have converted one account to NRO account. So that denotes your intention that, you want to be regarded as NRI. And therefore, it is advisable that you convert even other accounts to NRO account. You see, the practical challenge could be that there are some investments, where probably your bank account is linked to some shares. So say, for example, I'm taking Harish bhai some slightly more time to answer this question.
Yeah. Please.
So say, for example, there are some shares which are physical form. There's a demat will take time. Now, dividend is maybe, that dividend is match linked to this account. Maybe you want to continue with something. So that process can take time. But make it sure that, you're in your next visit, if the physical visit is required, to convert that bank to NRO. But otherwise, having converted one bank account, if there is no such practical challenge, it is better to convert all the accounts to NRO account.
So can you elaborate on who should apply for an OCI card and who can apply for an OCI card, and also the same for Aadhaar? So who can and who should?
So moment somebody takes up a US citizenship or any other country's citizenship, they will be, as I mentioned, it is advisable to apply for OCI card. So moment you are given up Indian citizenship, you are surrendering kind of Indian passport. You have got now passport of any other country. That means you have become overseas citizen. And it is now mandatory for you to have OCI card if you wish to make any transaction in India of immovable property or mutual fund or shares. Except for NRE and FCNR deposit, you can still continue with your original status, which was kind of person of Indian origin. But otherwise, OCI is a mandatory.
And for Aadhaar? Whether
other linking, I'm not too sure, but so far as NRIs are concerned, it is not mandatory. If you are OCI, then definitely not mandatory. Even NRI is not mandatory, but if you can link it to other, being Indian citizen, it will be easy for you to link PAN to other, which you should do. Nothing wrong in doing that. If you are OCI, it is not mandatory.
Okay, I'm skipping one question because I think the answer would be very long. It is in relation to restrictions for giving loan from NRO account.
So a loan from NRI is only available to relatives in India. Sorry, I think NRI loan is not possible. I'm sorry. So for money lying in NRI account cannot be, given to any company in India, nor individual can take loan. It is only under $250,000 that remittance can come to India relative. If you wish to Indian resident wishing to give to non-resident Indian, reverse, I'm talking about reverse. Indian resident wants to give to non-resident Indian, that is possible in NRO account, subject to that person being relative. But non-resident ordinary to Indian borrower is not permissible.
So even to a partnership firm not permissible.
Even to a partnership firm not permissible. As I mentioned, the structure could be, as they call it, structured obligation. So through NRE deposit or FCNR deposit, and then the borrower will borrow against the pledge of that deposit.
Can a charitable trust in India donate funds to a charitable trust in Canada?
I think I don't really am aware about.
So I will take this.
Yeah, please.
Your permission. So under the Income Tax Act, a charitable trust, if it wants to make any donations or charity out of India, they need to take a specific approval from the CBD or the Ministry of Revenue. Okay, so now this is one question. I think in your talk you mentioned that investment in real estate, non-resident is not allowed. And
so real estate,
there is a question which says that embassy REIT does hold for immovable property, and also all the multinational companies in India do hold for foreign property.
Yes.
So reconcile what
So when you say multinational in India hold property, the multinationals are having subsidiary in India. So for example, something known as, Microsoft India Private Limited. If that private limited company is owning a property, it is the Indian company which is owning a property and not Microsoft US. So that is a subsidiary in India which is owning a property. If you say there is a branch in India, something like, Citibank, which now got acquired by Axis Bank, the branch can own property subject to that permission. But subsidiary is an Indian entity, mind well, that is not a foreign company. Now, when it comes to REITs, there is a specific regime where they are allowed to invest in certain properties with certain classification, which has almost 75% completed properties and stuff like that. So, an intention is to invest on a rental yield and then earn interest out of it. What I meant when I say that, foreign entities and foreign nationals are not allowed, something like, George Soros, who would like to play havoc on Indian market. What happened to UAE in 2008? Suddenly when the asset bubble really burst, people just ran away. People just, because what used to happen in those times, today I book a flat in UAE, I pay 10% down payment. In 3 months down the line, the appreciation in property would be 10%. Therefore, on my investment, return is 100%. I'll sell the flat, earn 100%, and that went on, led to asset bubble, which will never happen in India. That's what I'm trying to say. But if you are REITs, that is allowed. If you are Indian subsidiary, it is always allowed because you are Indian company. Your shareholding is with foreign. So that is, I think, distinction is clear. I hope.
So here is a question which says that exchange, I will summarize, rephrase the question. Exchange fluctuation on foreign currency bank account, whether that is taxable in India or in US. They are asking, their question is for US. I think US it may be difficult for us to answer, but in India, whether exchange fluctuation. So I have deposited $1 lakh in US. Now I'm repatriating the rupee term, I'm getting, let us say, more money.
So if you look at my slides on equity shares valuation, say for example, that interesting question, because arising is that, the non-resident Indians or foreign companies or foreign national, when they invest in India in foreign currency, they have option, especially only with capital gains, that too on shares. Okay. If you're investing in shares, what they say is that you compute your capital gain in foreign currency. So for example, I invested when dollar rate was 45, I invested $1 lakh at that point of time and the exchange rate was 45. Therefore, I bought shares worth 45 lakh rupees. Today, I am selling shares in India, which is fetching me 82 lakh rupees. The 82 lakh rupees, since the investment was repatriable investment, I am allowed to repatriate and that is fetching me again $1 lakh. So therefore, in dollar terms, there is no capital gain. That is permissible for shares. But when it comes to immovable property, no. Immovable property, you will have to compute everything in Indian rupee and pay tax even on exchange loss that you have suffered as a foreign, non-resident Indian, because there is an actual depreciation in rupee. But when it comes to shares, yes, you can compute your capital gain in dollar terms. If you do not wish to do this dollar conversion and even apply cost inflation index as we do it under Indian Income Tax Act, then you are given concessional tax rate of 10%. If you do this conversion, then 20% tax on net gain after conversion. That is possible.
What about joint accounts with parents? Son became NRI, but the joint account holders are parents. Can I continue?
Yeah, you can continue. I think that NRI, NRO, the whole table which I have given has got detailed, reference to all these joint accounts. Only thing, the account will be held on former or survivor basis. That is what they say. The account NRI, NRO, FCNR cannot be held on either or basis. It is former or survivor. And if you wish your the joint holder to operate that account, there are only limited transactions for which it can be done on basis of power of attorney. Otherwise, it is former or survivor basis.
Can a foreign company invest 100% subsidiary in India which wants to start a resort and hotel business?
Yes, resort and hotel business is possible, but when you are buying the property for resort or hotel, see that the property is not agriculture. That property at the inception stage also should be non-agriculture. That is preferable, because if at all for some reason, you have to either change the place or you want to cancel that project, and if you're holding agricultural land, even though you might have bought, it will be very difficult for you to dispose it off, and then there could be penal provisions under FEMA. So business of a hotel is permissible, resort is permissible, no doubt about that.
Okay, one of the last questions that has come is can NRI invest in construction properties in India, and then can resident gift the capital gains back to my foreign account? I'm not able to follow this, sorry.
So under construction property for investment, NRI can invest as a retail investor or as an individual. If he wants to buy a flat in a housing society or under construction project, he can. If he wishes to start a construction development project on his own, he can do it in partnership on non-reputation basis. If he wants to do it on repatriation basis, then it has to be private limited company only. LLP is not allowed. For construction development project, LLP status is not allowed. You can do it under normal partnership on non-reputation basis or private limited on reputation basis construction development projects. In individual capacity, you can invest in residential or commercial properties, and that project could be under construction project.
Resident individual passed away, kids are in US. Can inheritance happen to the US kids?
Yes, that is possible. All the bank balance and everything can be, inherited by US residents, and you can, repatriate that proceeds under $1 million scheme.
How can I move my funds from my Indian savings in NRO to NRE?
You'll have to follow the process of $1 million scheme repatriation. You'll have to upload Form 15CA on Income Tax website and obtain Chartered Accountant certificate in Form 15CB. And you can transfer funds from NRO to NRE.
I'm an NRI for 10 years. Am I still required to file income tax return if I own property in India?
See, it is not mandatory, but we advise that, keep continuing filing your returns in India to establish that, all these years I am NRI. And when you want to come back to India permanently, or you wish to transfer your savings from US or wherever country that establishes that whatever was my Indian income, I have always disclosed it properly. And therefore, there is no income in addition to what I have filed in my tax return, which has arisen in India. And all my investments, which I'm bringing now back to India, my overseas wealth, which I'm transferring to India, has got supported by my foreign tax returns. So there's a clear distinction available. So if possible, keep continue filing a return in India too.
Yeah, I think pretty much we have covered most of the questions relevant. Do you want to ask any other further questions which have come in the check box later on, which I have not received? Here is a question. My daughter is in Australia. She can take her consultation fee in Indian NRO account. Then whether she's in Australia, whether fees she can take in India.
See, Australia tax office is more stricter than India, and if for the students of taxation, I always say that ATO website is a classic piece of literature. So Australian tax office is just very, very strict. So if you're taking fees in India, one exposure would be directly that you are probably asking Indian tax authorities also to make this income liable to tax in India, whereas principally this income should be liable to tax in Australia. So, for ease of, transaction, you would say that, resident Indian would be paying to NRO account in India, but it is not advisable to make credit in India. So we have seen cases where Indian employees, when they are deputed abroad, okay, so there's an Indian company which is deputing employees abroad. And because this Indian employees has got, monthly EMIs in India, housing loan and other, outflow for their family. So what sometimes they do, the Indian branch of the foreign company, I mean, because you're not subsidiary in foreign country, they pay salary to NRE account in India. There are a couple of court decisions where they've held that even though there is a direct credit of salary in India, this income is not taxable because the income has accrued overseas. You are asking question NRO account, which is purely rupee account, and therefore there is more risk of it also getting taxed in India. If it is remitted overseas, it will not be taxable in India at all. It will only be taxable in Australia. For you, it is advisable that these accounts are also disclosed in Australia. So if you pay tax there, if at all there is some TDS in India, there is tax withholding in India, you should get credit in Australia. Try to avoid such transaction because it is all, of course, I understand the remittance may not be possible and there's smaller amounts, but NRO account is slightly riskier transaction.
Person is a non-resident, salary earned in foreign country, no DTAA and bank account in outside country. Sorry. India income is credited to bank account in India. So foreign salary, and if the receipt of the money is directly to a bank account in India, then whether the amount will be taxable in India.
So that's what I mentioned about the case. There are a couple of cases in favor of taxpayer to say that, if you are working from abroad, if you are really stationed abroad, you are working from abroad, and you can establish based on your employment contract, that this is actually the salary. And if it is, I would advise that such salary should be credited to NRE account. That should be, at least care should be taken so that we can establish that there's a remittance from foreign to Indian NRE account. Then there are case laws to support that, income has actually earned overseas, accrued overseas. Now it is merely I'm receiving it in India. So at my discretion, I am saying that you credit it to NRE. I was entitled to receive it overseas, but I said that you park it in India. Then it will not be taxable.
So ideal situation should be that accept it out of India, if not possible, accept in India.
Yeah.
In NRE account.
Yes. See, NRE and FCNR transaction should be such that you yourself are transferring from your overseas account to India account. It is self to self.
Yeah.
So my own US account to my India account, my own UK account to my India, my own Singapore account to my own account. If it is self transaction, it shows that my income was earned there and I am remitting back to India. If it is a third party transaction credited to NRE or NRO, the Indian income tax law will question you that it is something known as an unexplained cash credit. They can question you. Now, what is the source of this credit? Why has third party gave you in NRE? So these are also the points to be borne in mind.
So there is one participant who has shared one website details. For any questions on FBAR, I will request the CVOCA team that when they circular all the other material presentation of Manoj Bhai, they also share these details of the website which has been received in the chat box.
We will do that.
With this, I think, yes, we are almost through with all the questions that were relevant.
Yes, I have one question. This is Bhupendra Deliwala, and I have a question on charities that we do from NRO account. Can you shed some lights on that, please?
So હવે આમાં શું થશે કે any donation from a non-resident from a foreign source as defined under the FCRA can be given to only a charitable trust which is registered under the FCRA. And a foreign source is something that is defined under the Foreign Contribution Regulation Act. You need to refer there whether you are covered as a foreign source. But as I understand, any donations from a non-resident to a charitable trust, the charitable trust has got to be registered under the FCRA.
Excuse me, I have a relevant question, I believe. A daughter who is resident in India, how much amount she can give to the mother who is NRI?
So that limit because you want to remit money overseas, and that is, or even to NRO account, the limit is $250,000 in a year. That is April to March.
Thank you.
Sir, I have a question. Sir, I have a question. I mean, I have never invested in stock market in India, but I lost 100,000 US dollars. So I was thinking to invest in, long term in India for the stocks. And can I, not pay any capital gain in India, but pay capital gain adjust with the existing capital loss in USA? I was wondering if you can help me on that.
So we'll have to look at US tax laws, how much carry forward loss they are allowed, I mean.
So basically right now it's saying 3,000 a year, and that's too much. So like the loss is like 150K right now. So maybe
Manoj,
I was thinking,
Manoj,
to
India માં
adjust
જો
to...
capital gains હશે તો પહેલા ઇન્ડિયામાં ટેક્સ ભરવું પડશે.
ઇન્ડિયામાં તો
US
tax
માં એનો
તમને
set off
મળશે.
મળી શકે according to
Oh,
US
અચ્છા.
laws.
Yeah.
અચ્છા,
પણ
ઇન્ડિયામાં
US
capital
laws
gain...
અનુસાર ઇન્ડિયામાં નહીં મળે.
India is
So
always
ઇન્ડિયામાં
going to
મારે
tax
capital
you.
gain ભરવો પડશે એમ કહો છો તમે?
Yes.
Oh,
India will always tax you.
okay, thank you.
I think
Hello.
now we have pretty much exhausted the time limit. So
Hello.
maybe one last
Yeah.
question we can take.
One question. So what is the tax liability under $1 million scheme?
So 1 million per se is transfer of savings from India. So 1 million can comprise of, inheritance proceeds, which will have no tax impact. So a chartered accountant will issue a certificate signifying that whatever is the tax exposure to this, say, $1 million, if you are withdrawing, say, $500,000 from India, there could be various components of this within this $500,000. It could be sale proceeds of residential flat. It could be dividend and over the years. So, basically there is no per se tax exposure, but whatever are the money which is flowing from India, chartered accountant will certify that whatever tax which was due has already been paid.
Yeah.
Okay.
So per se, $1 million repatriation has got no connection with tax. The taxation is in respect to the incomes.
Yeah.
Okay. So I can transfer from other savings account, PPF, into one of my NRO account and then transfer
Yes.
money under $1 million.
Yes.
Okay.
So so PPF interest is fully tax exempt. So money will come to your NRO account, and from NRO you can repatriate. If there are other credits in NRO which is liable to tax, then you will have to pay tax before remitting funds overseas.
Okay, thank you.
Hello.
Hello. I have a quick question. I know we are already at time, but I haven't been getting right answers from most of the CAs that I've reached out to in India. So my question is, when we buy a property in India, does it have to be a direct transfer to the builder, or can we use the money that we send as family maintenance to India if I want to be one of the joint owner on the property?
So if you want to be joint owner without contribution, you mean to say?
No, I want to be a joint owner. The money that I sent back home as family maintenance was, say, those funds I'm using to invest in that property. But how do I show that those funds are from me? Because when I'm selling the property, I won't be able to claim the capital gains correctly, right? In case I'm using family maintenance.
So, see, unfortunately, if you send money for family maintenance, I would assume that those monies are already consumed, in the sense that if you would have sent directly to your family account, say, for example, father or brother or mother, so those either would be regarded as a gift to India. If there is some money which is lying in your account, in your own NRO account, that money, if it is used for investment, it is fine. But if you say that money was sent for maintenance, now unfortunately what you want to do is then they will have to, somebody in India, your relative, will have to gift you money in your NRO account.
Okay. So there's no way that I can use the family maintenance funds to show as.
So basically,
Like,
family is
I
now
don't know where
returning.
that is.
So there is no family maintenance concept. So when you have remitted the money, it was treated as a gift. Now family is returning that money by way of gift back to you, kind of. I mean, I would just put it that way. That somebody is gifting you money in India in NRO account, subject to $250,000. That is the upper limit. Within that money will come to your NRO account, which can be used to buy property for your own share of whatever contribution that you want to make towards flat.
Okay. And do you think I'll get double taxed in case they are, adding that
So
money to
double
my
tax
NRO?
means
Because
I believe that in India, in US also, this gift, if it is from relative in India, it is not taxable in India. And even in US, if it is from relative, it is not taxable. There is some disclosure. If it is more than, I think, $100,000, there is some disclosure required, but it is not taxable even in US. So therefore, gift transaction per se will have no tax implication in India as well as in US.
Okay, understood. So basically, they'll have to give me back to the NRO account to be able to invest in India then.
Yes,
Okay.
yes.
Manoj bhai,
Understood. Thank you so much.
Manoj bhai,
Yeah.
if an NRI who is staying, say, last 20 years abroad, and if he brings, whenever he comes to in India with his passport, certain amount like $10,000, and he encashes with a private agency like in money lenders or in goldsmith people like sellers of the gold and all, and out of that remaining amount which he has spent over India, he deposit that amount of an cash into the NRO account, and substantial amount is been collected in the NRO account, and he makes the FDs and all. Can that amount of investment is permissible out of that amount, or if the link is provable, like visits to India and the $10,000 every time when he brought that to the India, and the savings can be proved, then that investment is permissible, or is there any difficulties that you may foresee like?
See, I mean, there's some CDF, currency disclosure form, which is required, for certain limits. So if you have done that, that should be the first evidence. Secondly, if bank has accepted dollars deposit as in NRO, that is a valid transaction. So if you have come with passport and this amount is disclosed on the passport, and if your bank has accepted that credit.
Manoj bhai, sorry to interrupt. The case is like he brought the currency in the dollar terms. He got converted from the private agencies in the cash, like Indian currency.
No.
And then that Indian currency, remainder amount he deposited into the NRO account.
I think we can take this question off because
the Indian authorized dealers only have that, otherwise privately I don't know whether it is.
Yeah, even the buyer who has exchanged is under default.
He is not authorized.
Exactly.
That FEMA default can come across, right?
Yeah.
But so far as income tax liability is concerned, can he still be able to prove that?
So your credits in NRO should be examined. I mean, all these years, if you say I want to repatriate now or all this question can anytime come from tax authorities.
Yeah. So Amit bhai jam kidhu na this is something fact based and can be answered by
offline
after understanding the proper facts.
I think we should now wind up the session. It's been late now.
Manoj bhai, one question last if possible.
Hello, Manoj bhai, I am Kantilal from Hyderabad. We both are senior citizens, more than 75 years, and we want to transfer all the life assets to our children who are NRIs. What is the right way?
So since you are resident in India, it is easily doable. You can remit $250,000 every year. So whatever money is lying in you can liquidate all your investments. Okay, if you wish to, whatever amount that you want to transfer, you gather that amount in any bank account of your and your wife, and from each individual, that is you and your wife, can remit, $250,000.
That's right. One thing, we are having some asset.
So you
house
have to
thing. Whether that we sell now or after our death, they will sell and can.
So that's a family decision.
Which is advisable.
That's a family decision whether they want to continue with house or not. They can inherit also. So your sons, they should have OCI card. They can inherit after your death. They can be also gifted also the flat right now. You can give the house property right now, which is there, to them while you are alive. That will solve a lot of, procedural aspect, because otherwise probate will be
They are
required.
also not wish to continue with that property. We want to sell, but before our death, we should sell and transfer to them, or after our death, which will be.
Yes, so the decision to hold the property or sell the property, it depends on your mutual consent. What is the class?
Taxation point of view, whether it is to do before or afterwards, that is I'm asking. Taxation point of view.
That is your choice, sir.
It is your choice. Taxable point means if you sell the property, it is taxable right now. Capital gain, you'll have to calculate that capital gain, and the net proceeds, you can transfer to your son. They can be gifted also. They can inherit also. If they give,
But one thing. No, I am having 3 children. It will be divided in 3, and capital gain will be divided in 3. If after my death, it will be sold, or after my death. 1 second.
I think.
I think Nandibhai, I appreciate your, but I think it is too fact based. I mean, see, this answer cannot be. I mean, this question cannot be answered in this manner. It requires your family's consent. What do you want to do? If possible, liquidate the investment and then repatriate or remit.
No, that is correct. I accept. Tax point of view, which is beneficial.
Okay, thank you everybody. Thank you, Manoj. I will now request CA Amit Shah to propose a well-deserved vote of thanks. Ami, please.
Thank you, Haresh bhai. So it's been a very interesting session. It's been a great journey from the basics to advanced learning about the NRI provisions. The coverage pertaining to NRE, NRO, transactions, residential status, taxation applicability, repatriation, TDS on various foreign transactions, etc. Also, there has been various interesting questions from the participants itself, which has added on to the session. Consistent participation from start to end proves the quality of session to be very crisp and informative with simple understanding. I, on behalf of CVOCA, extend a hearty vote of thanks to Manoj sir.
Thank you.
Thank you, sir.
My pleasure to be of service to CVOCA, my dear institution. Thank you. Thank you so much.
Thank you so much. We'll formally conclude the session. Thank you so much.
Thank you. Thanks everyone. Thanks.
Hello, Manoj bhai.
સર આની પીપીટી મળવાની છે. હેલો સર પીપીટી મળશે.